Everyone, welcome Steve Lemmons, one of the premier lending officers here in the state, county, country, world, if you will. He's been a good friend of mine and a very valued business asset to my team for many years. So we invited him on the call because we've all known that the interest rate has gone up and things continue to change in the financing space. So it's important for us to have a little bit more understanding of how we can navigate these uncertain waters to be successful in the shifting market. So why not bring in the expert himself? So one of the few, if not one of the only 5 in the entire city that has gone through a financial shift like this in the real estate market. So he knows firsthand how to be successful in that space. So I'm going to give him the floor, guys. Please give me your attention. They're all yours, Mr. Lemmons.
All right, thanks, Big Dan. Good morning, everyone. So what I'm going to do today is I'm going to break down a little bit of how the interest rate market works and to give you an idea of what's going on, because people think it's just the Fed or they think it's just, interest rates in general are climbing, and there's no real explanation as to what is going on. So it'll give you some insight into the market. We'll talk a little bit about the market, how it's shifting, what we see, all of those things. But I really want to dive into interest rates a little bit so you understand kind of how they work and what is the biggest factor that is contributing to the interest rate increase right now. So first thing, I'll give you a little bit of market update on interest rates. Interest rates, today, a rate quote that you get yesterday means absolutely nothing in today's world. In like today, this morning from yesterday, it is changing so rapidly. And by rapidly, I can tell you that rates from one day to the next may be up 0.25% or down 0.25%, up 0.5%, down 0.25%. They are moving at a speed that I haven't seen. And for any of you that know this, have been in the market that long, since 2001. And the biggest market mover then was 9/11. So the market is very, very volatile right now. And the volatility in the marketplace is creating rates, they're naturally moving upward a little bit. I will tell you that most rates are somewhere between 6.5% and 7.25%. So that is really where the market is right now, and it depends on the day. Sometimes yesterday it was like 6.625. 2 days ago, it was 7%. So it really is moving at a rapid rate from one day to the next. Now, a lot of people are just going, oh, this is the Fed acting, and these interest rates are moving, at the speed of light because they're worried about what the Fed is going to do next. Now, that is partially true, but the biggest indicator that we are seeing right now is something that most people don't think about in the marketplace. So in the world economy, which the world economy drives our local economy, whether or not we want to admit it or not. In the world economy right now, if you are paying attention to, global economics and things like that, you hear places like Japan, China, Europe, Canada, all of these places. Germany just released, double-digit inflation numbers, at about 11%. So all of these factors that are coming in from the global economy are affecting the US economy. And here's how it's affected. So when a government raises interest rates, what they are in essence trying to do is twofold. They are in essence trying to slow spending, one, and number two, they are trying to increase or add value to the currency for that particular country. So this week, what started out the interest rate swings was the ECB, or basically the Bank of England, which is the Fed in the United States. So it's the Bank of England, stated that they were going to raise rates in upwards of 200 basis points in November. What they are dealing with there is economic crisis. They have energy costs that are through the roof. They have a lot of different things. So they are trying to figure out a way to stimulate their currency so that things from other countries aren't more expensive than they were in the past. It's a way for them to basically alleviate inflation from a government perspective. If their currency, the euro, is weaker, it becomes more expensive for them to buy things from the United States, from Russia, China, Japan. We're all interconnected, whether or not we want to admit it or not. So their purpose for doing this was to increase the value of their currency, therefore decreasing the cost of items and services and goods that they have to buy from other countries so that they can manage inflation and the marketplace there. So that sent shockwaves through the market and it devalued the dollar. So at first, the information was really bad. And then the next day, it devalued the dollar against the euro and our rates went down. So, and what is happening with the dollar is because the dollar is so strong right now in the United States. So we're going to bring it back from Europe back to the United States now. So the dollar is so strong right now that people are taking money out of the bond market and putting it into the US dollar. So when money is taken out of the bond market, it drives rates upward. So if you have no buyers for bonds, which are what mortgage-backed securities are tied to, it is a mortgage-backed security bond. And then you have the 10-year treasury, all of these bonds. If there's no one buying bonds, the demand for them becomes less, therefore interest rates go up. So what is very interesting that happened in the middle part of this week is the Bank of England went from saying they're going to raise interest rates 200 basis points to almost creating an economic crisis in their short-term business model, to then they had to go and buy back hundreds of millions of dollars of what are called gilts. Gilts are treasury bonds in Europe or in England. So when they bought those back, that gave some stability back to the bond market, because the one concern about some of these countries, and it is a slight concern for the United States, that the bond market is going to fail because the strength of certain currencies, i.e. the US dollar, is so strong that people aren't wanting to invest in treasuries, they're wanting to invest in currency. So bringing that back full tilt to the United States, the reason why the volatility is there is because everything is hinging on the value of the dollar right now. The stronger the dollar, the worse interest rates are. The weaker the dollar, the better interest rates are, because they're going to take their money out of the dollar investments and they're going to put it back into treasuries from a safety perspective. So a couple of things that came out this week that are very important to know. The GDP was revised and in Q2. So basically what it means is it went from being slightly up to it being negative. So from an economic perspective, and I chuckle when I say this, not a political perspective, from an economic perspective, when there's 2 quarters of downturn or negative growth, it is considered a recession. So most economists now are saying that the US is in a recessionary status. The rest of the world is starting to come to terms with that, although admitting that it's, the 12-step program, the first step is admitting it. So it's a hard thing for them to admit, and they're going to do anything to fight it, because unfortunately in our world, it's very political. So you've got midterms coming up, and that word is bad for the midterms. So you've got all of these forces in play that are coming to fruition, and the numbers, unfortunately, they don't lie. So that, and people questioned that revision very strongly, is that it just hocus pocus to make it seem like it wasn't as bad as it was. And I don't know the answers to that. But in reality, with the revision, it pretty much says that the United States, if not in Q2 and Q3 when it comes out, will be in a recessionary status. Another piece of data that came out today, which up until recently, the key indicator for the Fed on whether or not inflation is running hot or not is what's called the PCE. It's the Personal Consumption Expenditure Index. That is how much a person spends on goods and services in comparison to a previous, year over year, quarter over quarter, all of those things. That number today, so it wasn't a surprising number because you could see things are getting more expensive at the, not necessarily at the gas pump, but the cost of food is up, energy prices, are up, all of these things. So the core PCE came out today and it was up 0.2%, which means that inflation is still an issue. So the Fed, unfortunately, can't stop with what they're doing. So their rate hike that they're going to do in November or in October is going to be pretty much, it's 100% chance that they're going to do a rate hike. The issue with the Fed and the fighting of the Fed right now that is very, very tricky is that you have a supply chain issue that no matter what the Fed raises rates to, they can't fix. So until that supply chain issue starts to get resolved, inflation is going to rear its ugly head. No offense to the Fed, they could raise rates 4%. It wouldn't necessarily stop anything from an inflationary perspective because the one thing they don't control is supply. The Fed's job and their only avenue in the economic perspective is to deal with demand. You've heard some words come out about demand destruction. You've heard all of these things. There's going to be some pain in the market. So the pain in the market that they're talking about is the only thing they can do is destruct demand. How they destruct demand is raising the interest rates for cars, credit cards, all of those things. So, and it has a subtle effect on mortgages, but the Fed actually raising rates has no direct effect on mortgages whatsoever. Now, the Fed has also started to do something this year that is having an effect on mortgages more than people want to admit. Prior to June of this year, every single month, or every single week for that matter, for the last, I'm not joking about this number, 12 years, the Fed has bought mortgage-backed securities and treasury bonds, basically feeding the fuel or fueling the fire of the marketplace to keep interest rates low to drive the market. The Fed, when they speak about qualitative tightening, what they are in essence doing is they have stopped buying those bonds. By them not being a buyer anymore, they were the guaranteed buyer in the market to create stability in it. So now they go to all private investors, countries. Japan is a big buyer of US bonds. You've got England, Canada, Mexico, China, all of these places, and these private investors in the United States that become the buyers of treasury bonds. Well, the government sees it as an advantage to buy treasury bonds, but because of the current value of the US dollar, it's very difficult for an investor, a private investor, to go, I want to buy in treasury bonds right now because they're not making the return that the currency is right now in the US. So they're putting their money towards that. So that is a lot of the reason why rates are very volatile right now and moving in an upward direction. So the Fed is an indirect player in it, but it is not the sole purpose of why rates are going up. They are literally sitting on the sidelines watching it. And I will tell you, the Fed, as horrible as this sounds, they are happy that rates are where they're at. It wasn't their idea. They know they don't control mortgage rates, but they are not unhappy with that because part of the inflationary fire that is out there is the housing market. So the housing market in certain cities is definitely starting to cool. We see it starting to cool here in Tucson. In Phoenix, it's definitely cooling very quickly. And it's not necessarily cooling to the point of what we call a correction or a massive loss or anything like that, because inventory is still not quite at pre-pandemic lows. What's happening in the market with regard to inventory, which is a whole nother crisis we have to deal with, is that everyone in 2020 and 2021 who currently owns a home refinanced their home at 2.5%, 3%. So they are currently sitting 6% below the current inflation rate. Not to mention, if they went to go sell that home and go rent a home, they would pay more in rent than they currently pay in their mortgage right now. So those people are sitting tight. Now, part of the demand destruction, as horrible as this sounds, is the Fed, the way they destruct demand. You think it's just from interest rate increases, but that's the catalyst. The interest rate demand that they create by raising interest rates on the short-term side, their ultimate goal, and this is going to sound horrible, and you can take your personal feelings, to the Fed all you want, but this is part of the economy, is they want to create unemployment. The Fed, when they talk about pain and demand destruction, they want the unemployment rate that's currently sitting at 3.7 to be closer to 6%, maybe even 8%. Because that in and of itself will stop people from spending and having the ability to fuel the inflation fire, then to hopefully, in the Fed's eyes, allow the supply chains to get back online, correct themselves, and even out supply and demand. So what does this mean for the Tucson market? Because that's where most of us, I think, that's our primary source of business. So the Tucson market, inventory is still relatively low. As you notice with, homes that are in really good shape, they're moving very quickly, especially homes with pools, because we have, a fair amount of out-of-state buyers, and homes that aren't in the greatest of shape, or, don't have pools or not the best area, they're not necessarily moving as quickly. So you will see this, and I think I heard Mara earlier talking about, this being a seller's market. It is currently probably about a 70% seller's market, 30% buyer's market. I will tell you, about the end of October, you're going to see it start to switch even more quickly. It may become 50-50, more of an even, and there is no economist in the country that thinks that by 2023, it will be pretty much a dominating buyer's market. The question with the buyer's market is, normally with the buyer's market, inventory goes up. The question remains, how will inventory move based on what happened in 2020 and 2021? So even though it's going to become a buyer's market, there's still going to be limited inventory. So you may have buyers all competing and negotiating for the same homes, but they're not going to be as there's not going to be as much, I'll just take it as is, I'm not going to do this. They're going to start negotiating with the marketplace. The other thing that is going to see that is coming out, it's coming out massively because of the rate increases, is some loans, especially VA and FHA loans. Because they're private investors now, the private investors don't want to offer higher rates because everyone, and I mean everyone in the economy, sees that rates are coming down in the near future. And the near future is probably 12 to 24 months. And by down, Fannie Mae announced that they think that rates are going to be, the average rate in 2023 will be around 4.5%. So currently we're at 6.7 average. They're saying they're going to go down to 4.5%. That's a 2% change in interest rates. So if you were looking at it from an investment perspective, why would you want to offer rates at 7.25 at 0 points, or 6.875 at 0 points with no cost to get that rate, when they know that 7 to 12 to 18 months from now, that mortgage is probably going to be refinanced? There's no return on their investment from these private investors. The Fed, when they bought mortgage-backed securities, didn't care. But private investors look to make returns on their money, and they care. So I've heard some crazy stories this week. Actually, somebody from Keller, on, I believe, one of Dan's on the team there, the loan officer was quoting a rate of like 6.625, and it had a massive amount of points attached to it. That's because their particular rate sheet didn't have a higher rate that had 0 points anymore, because the investors in the secondary market are not offering those rates. So when it comes down to an offer for that buyer, this happened to be a VA buyer, I believe. And then there was also a conventional buyer that I spoke to about on it, but there was a VA buyer. For them to pay 2.625 points on a 0 down loan and they have $5,000 in the bank, the only way for them to buy that home is to get seller concessions, which is why you're seeing seller concessions come back into the marketplace with a vengeance. And that is part of it becoming a buyer's market because of the need for some of these buyers to get seller concessions in order to pay for their rate, because a rate at 0 points in some scenarios doesn't make sense, or it's not even offered right now, let alone it doesn't make sense, but it's not even offered right now. So it is a very, very unique interest rate market. And as it starts to stabilize, so will the interest rate market. But the volatility, I mean, you send out a pre-qual, you get a pre-qual for a buyer on a home from Tuesday, and I kid you not, by Thursday, it could be a completely different scenario. One of the scenarios that I'm talking about with someone on Dan's team, they had a pre-qual from August 10th. August 10th is so far out of the box. The rate on the pre-qual was 5.99. It's so far out from where reality is right now. Your pre-quals really need to be done almost the same day the offer is put in, just so you really have an idea of what the buyer is really looking at. I had more agents call me on Monday because from Friday to Monday last week, rates went up by 0.5%. I had more agents call me on Monday asking about where our rates are at because the buyer got in contract over the weekend and no longer wanted to buy because of the 0.5% increase in rates. Now, during this week, rates are down 0.3%. So on Monday, they were up 0.5. Today, they're down 3/8 from that 0.5. So those crazy movements in the market are very, very hard to follow, and they're hard to guess. I will tell you, I am normally very good at guessing what the interest rate market is going to do. I would have told you that interest rates were probably going to go up today from the PCE response, but the dollar is not as strong as it has been. So people are investing in bonds. So the bond market is actually slightly rallying today, therefore keeping interest rates flat. That PCE core that came out today should have raised interest rates just because of the data itself. The data is taking second position now to whatever the US Treasuries and whatever the dollar is doing. So those are becoming the key indicators for what interest rates are going to do in the marketplace. So those are some insights into the market, and hopefully it helps you guys when you're talking to clients about why interest rates are moving, because most of the economy tends to think that it is really the Fed, and the Fed is only a part of it. There are so many other factors right now that are coming into it. And the more we talk to our clients about it, about being quick with their responses, on offers, I had a deal that put in an offer. They asked for a 3-day response time, the seller. That's dangerous to a buyer right now. So, and it's explaining to that listing agent that, hey, can we get an answer quicker on this, is because the market is extremely volatile with regard to interest rates, and my buyer is going to be sitting in the marketplace for 2-3 days while we wait for an answer on this. So those kind of things become very important in your negotiating and conversations with agents on both sides of the transaction, just to give foresight to everyone involved that just because you have a pre-qual at 6.625%, if rates jump to 7 or 7.8%, it could be a massive move for that buyer and could prevent them from buying. We're seeing it in Phoenix more than we are seeing in Tucson. We have buyers canceling contracts in Phoenix just because of interest rate moves, and they didn't lock in. So the other part of the market that is very interesting to watch, especially with your new home, so anyone who has new home contracts in place, we have seen, I probably have taken 3 new clients in the past 2 weeks. They're in contract on a new build. They're locked in at, like, one of them was locked in at 3.99% on a 9-month lock. They did it in, I think, January or February or something like that. So the builders, they go out and look at their home, and this home is in a framing stage still. So it's literally just been framed. There's no stucco on it. it's literally 4 or 5 months from being built. So what these buyers are seeing, great, I'm locked in, I'm so far below the market, this is great. And then the reality sets in that I'm not going to be able to meet my deadline for that lock because the builders are still having issues building homes in a timely manner. So it's an opportunity for you, with your clients on it, to watch what is going on with their loans. If you have new construction deals, all 3 of those buyers walked away from their earnest money and bought resale homes. And that's because they know that their lock is not going to be able to be saved. So their rate of 4% or 5% that they had locked in means absolutely nothing because the home is not going to be done. And it's not going to be done anywhere close to where their lock goes. We're talking this one, his lock expires in October. He's allowed one 30-day extension, which would take him to November. They're projecting his home to be done in March. Literally, he went in contract in January. So you're talking 14 to 15 months to build a D.R. Horton home. And this is happening. It's all 3 of these buyers. What is interesting, they were all D.R. Horton buyers. So I don't know if D.R. Horton's feeling it more than others, or we're just not seeing it from anyone. It just happened to be unique that all 3 of these buyers were D.R. Horton buyers. So if you have new homes in the backlog of your pipeline, make sure you're watching interest rates very closely. Because the last thing you want to do is have a deal sit in escrow for 10 months and then cancel. It's just a waste of time for you. So stay in touch with them, watch the market, and really just be in communication with your clients, because if you're not, I guarantee you there's nervousness on that side. And if you don't alleviate that nervousness, it's going to be catastrophic. That's pretty much what I got today. So the biggest thing about today on it is it's not good news or bad news. It's just news. Everyone's getting into, oh, interest rates are so bad right now. In reality, it's our market, and all we can do is sell to our market right now. So it's not good news. It's not bad news today. It's really just information so that you can be the expert that informs your clients on what's going on in the market to best advise them on how to do it, when to do it, and, let them know, because the more knowledge you have, the more peace that you're going to give to them in the transaction. Any questions at all?
I think that's the best nugget to take away from it, is providing information and education. So thank you so much for jumping on this call and explaining all the moving parts that we don't particularly see. I have a question about a VA loan. Are all VA loans assumable?
All VA loans are assumable.
Okay.
So I can go into a little bit about assumability because it's something that's coming in the marketplace a little bit. So all VA loans and FHA loans are assumable loans. So what that means is that if you're qualified, you can assume that loan. So let's just say a buyer, as an example, I'm just going to use this as an example. You have a VA buyer who wants to buy a home, and the current buyer or the current owner has a loan at 2.875% at 200 grand. And they're selling that home for 300 grand. If that veteran has the money, they can put down $100,000 and buy and get that VA loan and assume it, assuming they are a qualified veteran for that new home. And you do a sales transaction and they assume the loan versus actually getting a new mortgage at the current marketplace. The issue with assumability in today's market is this was a big thing in the 80s, but you got to get the average home in the 80s had $20,000 of equity in it. In today's market, some of these homes have 100, 150, 200 grand in equity in it. So, but you have this is going to sound kind of crazy. You have a conventional buyer who is buying a home, and the current loan on that home is a VA or is an FHA loan, because a non-veteran cannot assume a VA loan. But on an FHA loan, let's say they have an FHA loan on that at 2.875% and it has mortgage insurance, so it's bringing them to like 3.6%. That conventional buyer can put down the difference between the sales price and their loan amounts and buy that home and assume that FHA loan from the buyer or from the seller. So it is definitely an opportunity for you guys if it makes sense. It's not going to be like an everyday thing, but it makes sense for you to look at your title reports, look at your property profiles to see what type of loan is currently on that home, because it may make sense for your buyers to assume that loan for sure.
I've got a listing coming to market in the next couple of weeks. Current owner's VA owes 177 on it, but we're coming to market at 379. I'm just trying to drum up potential ideas, to make it marketable.
Well, I would put it on there that it's a VA loan currently on your listing saying that, but obviously I can tell you the chances of that being assumed by another veteran. I mean, you're talking about $200,000 spread between the two. It's going to be difficult, but It doesn't hurt for you to put the marketing on there for sure.
Okay. That's what I was curious about. All right. Thank you.
There might be opportunities in people that have refinanced in the last year. If you look at the information, the tax information, you can tell if they have refinanced, and that's an opportunity for a buyer to assume a loan.
Absolutely. Yes. Looking at tax records and property profiles right now is very important when you're going in to put an offer on a home, so that you have full information on what is available for them. Because again, you have a buyer who is going to put down $200,000 on a conventional loan, and they come in and they see that they have an FHA loan at, with putting 150 down. If I was an agent, I'd be saying it's better for you to assume that loan than it is for you to take a conventional loan today. 100%.
The great thing is, guys, there's tons of opportunity to be creative in this market. And that's why I wanted to introduce you to Steve and some of the ideas that he brings. And it's about understanding what's happening at a big level so that we can communicate to both our buyers and sellers. Some key takeaways there is that urgency is definitely important right now, especially if rates are changing, 0.25% or 0.5% a day. That could change somebody's eligibility overnight. So speed to the agreements is important. Two other things to think about, as Steve said, that now it's really important if you have a buyer that needs closing costs, there's going to be a lot more fees assigned to loans because they're not getting the interest over return, because the next year and a half, 2 years, everything they're expecting to change and the refinances will happen. So these lenders are going to lose out on their potential monies and profits. So they're going to want to get it up front. So some of the closing cost assistance will help with that. So now it's important to have conversations with both buyers and sellers around the fact that we may need to position ourselves either guarding against closing costs or asking for them. So we'll continue on that conversation later in the week. And then in the chat, Jen put she's got a VA buyer who tried to assume a seller's VA loan, but they needed to have $250,000 cash to cover the equity difference.
Yep. And
right.
That's the issue right there. That is the issue with assumability. And, again, it's not to say that it's not something to have in your tool belt for you to go out and market, but keep in mind, I'm telling you this, all these agents, I've had a numerous amount of calls from agents about, assumability on loans. I mean, big agents calling me, asking questions about it. But the reality of it is they have to basically pay that difference to cover it. And it's very difficult for most VA buyers or FHA buyers to do it. It's really, if you have a conventional buyer who is buying a home that the seller has an FHA loan, there's definitely potential there if they're putting down enough money to cover the difference, for sure.
All right. Well, guys, was this worth your time this morning? Some head nods and thumbs up, right? This is knowledge, right? The application of knowledge is power in our business. So be more informed, be a better skills-based agent will help you navigate more uncertain waters. So everyone, I put Steve's contact information in the chat. If you have more questions, or if you wanted to ask him a question you didn't want to ask in a public forum, I know that he's okay with receiving your phone calls and emails and texts, because that's what he does in this business. It's all about the relationship with understandings, making sure our clients are as well informed as our agents so that we can have a really good transaction. Because after all, when we know what monsters lie before us, we know which weapons to bring into battle. So Steve, thank you again for spending some time with us this morning. Guys, everyone enjoy your Friday mornings. I want to say thank you so much for investing in us every day and then making sure that you guys are growing your base and being better for your clientele. So anything else before we go? No?
Thank
All
you,
right.
everyone.